Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. Today's guest is a visionary, and in the next 40 minutes, he's going to outline the future of broking. As insurance placement evolves from being the movement of documents around the market to a seamless flow of data between parties, we're on the cusp of a big bang in complex insurance. If you think that this is something that won't be happening anytime soon, you're completely wrong. It's already happening. Anthony Siggers is the digital lead for Marsh Specialty UK, and Marsh has already fully digitised 70% of its London slips. Given that Marsh places about $15 billion of premium a year into the London market, this is one tech change that is already way past the tipping point. If a massive broker like Marsh can do it, so can everybody else. So we're digitising the market. But what next? That's what we spend most of this podcast discussing. For example, how much of the market will be lead capacity and how much automatic or algorithmic follow? What will happen to costs, commissions, and insurance penetration? And what about the impact of AI? And what are the secondary effects of all this change likely to be? Siggers has been implementing technology and pursuing entrepreneurial ideas in and around insurance and the financial markets for 30 years. He's eloquent and he's also great fun. This interview will completely change your perception of where the syndicated insurance and reinsurance markets are heading and how fast they're doing so. If you only listen to one podcast this year, make sure it's this one. Enjoy the podcast. Anthony, welcome to the Voice of Insurance.
Thank you for having me.
Anyone who doesn't know you, why don't you just give us a quick run through of your career, how you got into insurance and how you've ended up where you are today?
Okay, well, crikey, I've been in the industry for 30 years now. I started out in consulting, did some projects there in insurance, including some of the first attempts to digitise the London market. Left there in around 2000, which of course was the dot-com boom, so did my first startup in 2000. I was the co-founder of a company called RiskClick. We had great names back then. After that, I did...
Click for cover.
Exactly. After that, actually, I did another startup straight away. That was in equities trading, which was
And what happened to RiskClick?
RiskClick we sold to Oracle in the end.
Oracle, wow. What did Oracle end up doing with it? Because, they're probably the largest IT firm in the world at that point.
You know what? So the challenge back then was moving documents around the value chain, right? So we were trying to get documents from clients to retail brokers to wholesale brokers. And there was no secure way of doing that. So we literally created an online deal room. And by the way, guess what? That's what SharePoint is today, right? So actually, we kind of,
So it's a nice secure place. You could basically put the thing up there in the cloud. It's secure. It's in a special room.
You can track who's got access, who's doing what. Yeah. So, actually a great idea, but something which became completely generic in the end.
It's still a feature in some of their software.
Yeah, absolutely. Yeah. So Oracle had a thing called IFS, which is the equivalent of SharePoint. Yeah.
So what was next?
So then I did a startup in equities trading, which was fascinating actually because it gave me an insight into what's happening in equities, which, by the way, is very similar to what's happening in insurance now. So that was an interesting insight. But I got dragged back into insurance after that and went and joined Willis, where I ran the SME segment globally, including an acquisition actually called Insurance Noodle, another great name.
I remember that. Yes, I remember that. I think it's no longer part of Willis, is it? Or
no, we sold it off again. The problem with the SME business is that it's very hard for the big brokers to make money out of that, right? Because you have to handle it in a completely different way. It has to be fully digitized. And of course, back then it was very hard to do that. And therefore, we would kind of grow this pocket of business, but actually not make money out of it. So we ended up carving off that entire segment.
What's the point in doing it if you can't make any money out of it?
Well,
that's no fun.
There you go.
What was next?
So then at Willis, I became the global head of broking analytics and technology, and was part of a team that did some pretty interesting stuff. Actually, we were the first organization to create a matching tool, an algorithmic matching tool to match risk to markets. That was called Market Match. We built out a platform called Will Place.
I remember that. I remember covering that at the time. It was quite exciting, actually. I thought it was pretty good.
Yeah, it was innovative. And actually, a lot of the stuff we invented back then is now becoming more commonplace in the market today.
And then next...
So after that, so I carried on at Willis for 9 years in the end, and then got the startup bug again. So I set up my next startup with a friend called Hemant Shah, who used to run RMS, who was the co-founder of RMS actually, and that was called Archipelago. So Archipelago was in the property risk management space.
You had a very brief sojourn. You actually strangely, you ran the Insurance Insider for a very short time. But
I did. You know what? I was in the process of setting up Archipelago and wasn't sure whether it was going to come off or not. And I thought, I'll tell you what, this would be quite fun and interesting.
Well, it was fun. It was fun.
So I think I had about 3 months there, but it was fascinating to see what you guys do.
Well, I learned to call you Siggers, so is it okay to call you Siggers for the rest of the podcast?
Absolutely, yeah.
So lead us up to the present. Now, what's your role now here at Marsh?
So about 3 years ago, I got the opportunity to come to Marsh. It's actually the old Willis team. So the team that did all that interesting stuff back in the day with Market Match and Will Place, they came to Marsh and then said, why don't you come join? And I jumped at the opportunity. I mean, for someone who's been trying to drive change and innovation across the market for so long, being at the largest broker in the market is very significant because really you do need scale to drive change.
So it's just a different proposition, isn't it? If you're number one and you've got resources, you've got the backing of management and saying, right, come on, let's really make this work.
Yeah, and what a time to be doing it, right? I mean, there's so much going on in the marketplace. This is a very exciting place to be right now.
Yes, so tell us what you're up to, because Marsh is up to an awful lot.
I think, first of all, frankly, the world is changing. I mean, there is exponential change coming, AI, obviously, but there's so many other things. It could be DNA synthesis, quantum computing, fusion power, right? I mean, all these things are happening in parallel. So there's just such an environment of change. Our clients are going through a huge period of destabilization. They have so much uncertainty and emerging risk that they have to face. So it's a very compelling time to be in the world of risk management. But of course, the world of risk management has not kept up with our clients' industries. We haven't digitized in the same way as they have. And frankly, we have to get our own house in order. So I'm really tasked in London with helping us to do that in the London market, but then thinking about how that plays out all the way upstream, frankly, because London is a recipient of business from the retail network. 75% of what we do in London is coming from the network. And of course, the network is interacting with our clients. So we have to think about that entire end-to-end journey from client, retailer, wholesaler, and into the markets, and indeed into reinsurers, and digitizing that entire chain.
So I suppose we're at the wrong end of the chain, aren't we? You ideally want that digital journey to begin as soon as the risk manager is talking to that broker, wherever they are in the world.
Yeah. We're doing what we can in London, and then we're working back up the chain. So, for example, the fundamental shift we have to make is to stop trading through documents and start trading through data. We're basically an analog industry.
Yeah, because at the moment, it just could be PPL or it could be whatever, but it's, hey, here's the inspection report. I suppose the slip might have been digitised itself, but very little else attached to it really is.
Well, not even the slip. I mean, frankly, before we started this process at Marsh of digitising the slips, it was done through Word documents, and everyone does that. So you create a collection of documents and you email it between the participants. And of course, what that means is that every participant then has to pull the data out of those documents and key it into their systems. So you get fantastic systems which are doing incredible things like technical pricing. But of course, the interaction between those systems is entirely analog. It's effectively the same as printing out the document and faxing it. It's that bad because at every step you're having to rekey the data.
So how are you doing it? You're working on this right now, or is it working already?
We're kind of 18 months into a fundamental transformation of the way we trade to going to this paradigm we call data first. So we are digitizing the slips. We're using a platform. It's actually a platform called Whitespace, but frankly, that's plumbing. It's the best technology out there right now. But what we're doing is digitizing the slips so that the slips are not actually documents. They're actually data. I can present to you the slip in JSON format. And that means that machines can read it. And if machines can read it, I can start to automate certain tasks which otherwise I would not be able to automate. So yeah, we're a long way in. 70% of our entire flow, and by the way, we put $15 billion of premium into the market. 70% of our entire flow last month went through the Whitespace platform and was fully digitized.
And JSON, that's a particular sort of file format, isn't it? Brief explanation for anyone who doesn't understand that.
Yeah, it's just a way of passing structured data between machines. So I create this JSON format, which literally has a bit of data and a tag which says what the data is. And then I can have that read by a machine without having to rekey it. Otherwise, I email you a document, you've got to rekey all the data from that document into a screen in your system.
And I suppose there are tons of solutions, aren't there, out there that say, my thing will do that and it'll populate your system and all the fields it needs to populate. But actually, why would you do that way if you could do it properly in the first place?
Well, I'll tell you what, it's a great frustration of mine, right? Because there are so many startups focusing their efforts on this whole process of ingesting emails and documents. So they receive an email, they pull the data out, they put that data into a system. There's dozens of companies doing that. But that's not the real problem. The real problem is, why do those emails and documents exist in the first place? That's
why was it ever done that way?
Yeah.
Actually, I went to one of these, a tech conference where you had these breakout sessions, and it was quite confessional. And as a journalist, well, I've always declared I said, look, I'm a journalist, so, don't say anything that you wouldn't want to be sort of, but also I declared that I wouldn't be reporting on any of this stuff. I said, this is just four walls. The most interesting thing that happened was somebody said, well, we've got this real problem with this old mainframe, and it's in the basement, and it's one of the ones with a green screen. But it's still, we haven't been able to get all our stuff off that, and I don't know how. And so the workaround was that there was this video camera looking at the green screen, and it was using text recognition, but very sophisticated text recognition, and then that would send it to the other system. So it would just read the database. Someone had to key this thing in. But it's sort of, yes, of course, you wouldn't design a system to be that way, but this was the best workaround. So you're sort of saying, we're going to avoid all those kind of crazy, yes.
It's putting a sticking plaster on. It doesn't tackle the fundamental issues. And by the way, that's quite creative. We do a lot of that, by the way, things like, they call them robotics, process automation, where you effectively replicate what a human being is doing, right, and have them interact with an old system. I mean, it's crazy, yeah. You need to modernize the systems architecture. You need to be moving data between systems via APIs.
It's like the Henry Ford thing, if I asked my customers what they wanted, they would just say faster horses. You'd say, actually, yeah, okay, maybe you should try driving Mr. Ford's Model T cars. It may be slightly better than a horse, more versatile, more useful, and go further without eating hay or getting tired out and getting lame, etc.
Exactly.
But then the funny thing is, how do you bring the people along with you? I suppose the conflict between technology and insurance, sort of particularly London insurance, has always been that the technologists said, why are you doing it this way? And the underwriters saying, well, because we love doing it this way. We've always liked the face-to-face. We like going down the pub and all this other stuff. Has the technology got to the point where now it's so easy to use? You've made the user experience whatever you want it to be, and then all this other stuff in the background. As a journalist, we've got a content management system, which is just a thing that helps you put your stories on the internet, and basically you put the text in a box and you put a headline in another box, and then you hit publish, and that's about it, really. I remember when the technologists came and it showed the system to us, we said, yeah, but we use Word documents, and how does it interact with Word? And they said, well, no, but you won't be using Word documents. You'll be writing it all in this horrid little box. But being realistic, of course, we did everything in Word and had them in folders, and only at the end we would publish anything on this system. And then, of course, the formatting all went wrong. But there you are. But just every CMS in the world, every journalist listening to this will agree with me on this. So if you've got over that, now hopefully that user experience is going to get better and better and better. So sort of you can work any way you want, but in the background, all this stuff is still happening in the most efficient possible way. Is that?
The change management challenge here is significant.
Because it's the people.
It's about the people. And the reality is, if you look back over the last 20 years, actually 20 years ago, there's a thing called the administrative cost ratio, right? It's basically the cost of the insurer side of the equation to administer a transaction, right? And there's a Lloyd's statistic on this. By the way, it's part of the expense ratio. But 20 years ago, the administrative cost ratio was 7%. Now it's 12%. So actually, in the last 20 years, despite billions of dollars of investment in technology, we have got significantly worse. And that's because we haven't changed.
Yeah. How come we've got worse? I don't get it.
You know what? In the old days, it was entirely analog. You would walk a document into the market and the underwriter would read through it, scribble on it, and make a decision. Now we have these fantastic systems. We have these pricing systems. We have these modeling systems. We have actually some technical rigor behind how we go about the insurance process. But as I say, the connection between those systems is basically fax, paper, it's documents. So at each stage, I'm having to rekey what's in the document into the systems. So what I've done is introduce this kind of digital to analog flow, and the whole thing breakdowns because I'm replicating all of that cost every time I rekey stuff.
So there's the Data Council in London. Everybody's agreeing. Everybody absolutely agrees. So is it really the sort of Accord data standards? Is there enough there? Or did you have to build any of your own standards as well on top to get everything out of an inspection report, or everything that an underwriter might want to see, for example.
So the standards are there. There is no excuse on the standards.
Oh, so they're really good enough.
Yeah,
I mean,
the GRLC standards, the Accord GRLC, the CDR, it's good enough. That's not the challenge.
That's common
now.
data record.
In fact, the technology's there as well. Some of the placement platforms out there now are good enough.
So you really could get everything you wanted, every nuance and detail out of a complex property program, and it could be dumped into that format and pretty much...
Yeah, but by the way, the risk is you try and do too much, right? You don't have to get every single bit of information into structured data, right? So you take a property risk, there'll always be a whole bunch of engineering reports, for example, that you keep as attachments, but the core data set.
Because that's if you really want to drill down, that's the whole point, isn't it?
Yeah.
It's like, well, this is the top location. Of course, someone to look at the engineering report.
Yeah. We're not trying to structure everything into data. We're trying to get the 80% that is used every time into structured data.
I want to know what the limit is, and I want to know what some insured is. Let's just get
by the way, a schedule of values, right? I mean, that is the worst example of duplicative activity in the marketplace.
Yes, every time I talk to a property underwriter, my team cleans this data and they find something wrong with it. The broker's already cleaned it and sent it in. And then, all 16 of us on this placement all do the same thing.
Yeah. On a big one, there could be 100 different insurers, and there could be...
Especially if there's a lot of facultative on the back around the side of it.
Yeah. And there could be 4,000 buildings, which are represented by 4,000 rows in the spreadsheet, and it has to be cleansed, and it takes up to 2 weeks to do something like that. And every single insurer does it. So it's absolutely bonkers that the market operates that way, when what you could do is capture that data once in a consistent structured format and have everybody just access that structured data.
Just give them the access, of course. Yeah, I'm showing you this risk. Here you are.
Absolutely. And that's where we went with Archipelago, by the way. I mean, that was the whole premise for how we ran that business.
Actually, what's happened to Archipelago?
It's going strong. I mean, actually, I was looking it up. They've got 2,000 clients on the platform now, over $10 trillion worth of property. So it's pretty much fundamentally changed the way that large property placements work. Others have copied it. So actually, Marsh has a fantastic version, which is a competing product to Archipelago. But it has changed the game.
So in terms of the technology, how much do you have to build yourself, do you feel? Or it doesn't sound like you've had to do that. It sounds like there's a solution already out there for most things that you want.
Yeah, I think you've got to decide what is going to add competitive advantage versus actually what is just a utility. You wouldn't, as a big broker, for example, or anyone, go out and build an email system. It just wouldn't make any sense. Yeah. But you might want to build something, an analytical platform, for example, that is really differentiating. And as I say, gives you competitive advantage. So certainly our approach is to try and figure that out, use partners that are providing utilities. And of course, if you have the scale, and not everyone does, then you can afford to build. And actually, you may want to use partners to help you build as long as you retain the IP. But if you have the scale, you want to be driving competitive advantage. If you don't, you're going to end up having to buy third-party solutions. And of course, everyone can buy them.
Is it sometimes just, it ain't what you do, it's the way that you do it? If you were just the first person to buy the third-party solution and really embrace it, you're still going to get the benefit, aren't you? And then, of course, the nice thing about third-party solutions, of course, is it's their imperative to have the new version and the new version and the new version, because that's their job. Whereas if you build your own technology, after year 3, someone says, oh, this is getting a bit clunky, isn't it? It doesn't work with that new file format that's coming out. And should we spend the extra 10 million on getting that up to date? And you don't have the commercial imperative, do you?
No, quite. And of course, that is a risk. If you build your own, can you afford to maintain it? Can you get the best talent in your organisation?
I suppose with you being at Marsh, that's probably is a problem that solves itself, because you can always answer yes. You can probably say, yes, we have got the scale, and so we can do it.
I think we can. By the way, though, if we were just to adopt the same platform as everybody else, what we're doing here is we're capturing data in a way that's never been done before. And the power of data is proportional to scale, and Marsh has more data than anybody else. So ultimately, the strategic differentiator for Marsh here is the fact that we will be capturing data on everything and have more data than anybody else.
You'll be able to go to that risk manager, and it won't be a very rough indication anymore. It'll be a pretty clear indication. I mean, we used to say VRI, very rough indication of what we think we're going to be able to place this for. Sounds like the VRI of the future it won't be VRI. It won't be a rough indication. It'll be an indication, and it'll be fairly firm, actually, won't it? Caveat that obviously there could be a catastrophe tomorrow. This is the price as of today. A bit like at the stockbroker, it's open for 33 seconds.
Yeah.
And if you either want to buy or you don't now, but yeah, okay, all bets are off after 30 seconds because the market may change. But
Well, I think there's two parts there, right? I mean, certainly in terms of our risk advisors, the client-facing risk advisors, we're getting to the point where we're going to be able to give them access to the entire world's knowledge of risk management, best practices, loss histories, technical pricing, the entire world's knowledge accessible through AI tooling, combined with the proprietary knowledge of everything that Marsh has ever done. And just imagine the power of that for a risk advisor.
it would be very useful. Yes, as at that point, you'd be saying, yeah, I think we should always talk to them because they're going to give us a really interesting view of everything we need to do and also how much we need to buy and all that kind of stuff. Sounds like brokers, once they're freed up from doing a lot of the placement and everything else, they'll be able to become more client-facing.
Well, I think there's two pieces to this. There is that client-facing aspect, but there's also a very important role, which is market-facing. And we see the role of the brokers in London, for example, changing fundamentally, but still there's an incredibly important role to play. So the way we see that playing out is we anticipate a world where our brokers have a trading screen, not dissimilar to the Bloombergs or the Reuters you see in equities trading.
Yeah.
Every risk they are working on will be in that trading screen. And they'll be able to automate a lot of the activities they do, especially around the follow market, through the trading screen. So it becomes a matter of I can fire out requests for indications with a single click. The entire follow market is probably hooked up digitally and able to come back with their VRIs, so I can see everything in the trading screen. By the way, I think those offers of capacity will come with client discounts, so we start to verticalize the follow market.
So leader will get leader's price and then everyone will be pitching leader's price minus something.
Yeah. The important role of the brokers becomes negotiating those lead terms, right? I mean, that's when they need to focus their attention. But all the follow capacity, we make sure it's all full follow. So there aren't any exceptions to that. There's no claims agreements parties. It's full follow. And then they offer a client discount.
Yeah. And then we don't want to be messing around with saying, oh, I'll do this, but not including that. And you get this patchwork quilt of there's gaps in layers and all that kind of thing.
Absolutely. And of course, what that does is it brings competitive pricing dynamics to the follow market, but also rewards the leads because the leads are now getting a better price.
And they're not being paid a leader's fee, they're just getting their price and everyone else has got slightly less.
Yeah, absolutely.
Yeah, that's probably the best way of working it out, isn't it? Would that change the dynamics of the market in an uncompetitive way? Because old school broking, you talk about blocking the market. It's like, you've gone out and you've basically blocked the market so that everybody's on this thing so that no one can come and compete with you. Will we end up like that? Or I suppose the competitive nature of the market will mean that it'll always find another way. For example, so, in a particular class, if somebody is the ultimate leader, swings this $2 billion line behind them of the whole market bound in all sorts of consortia and different arrangements, would that be necessarily good for the customer? And I suppose you as Marsh, you might say, well, actually, we better have some alternative leads here, haven't we? In case he suddenly wakes up with a monster ego and decides that they're masters of the universe and they can set whatever price they want.
Yeah, hey, I mean, this is all dependent on maintaining a vibrant lead market, and we are absolutely going to encourage that.
And in order to have a vibrant lead market, you need to have vibrant alternative lead markets.
Absolutely. And also, by the way, you need to make it easier and cheaper and faster for them to deal with us. So a lot of the stuff we're doing around digitizing the documents actually is not so much a benefit for us, it's a benefit for the market because they now can act faster on that data in a way they've never been able to do before. So by working with Marsh, those lead markets will find it cheaper and easier. But once you have those vibrant leads, then the entire follow market, we think, can be placed algorithmically or through our quota shares.
What sort of percentage do you think we're going to end up with? At the moment, I mean, everything's pushing up to 20 to 30%. And do you think it will be over 50? You'll have your facility. There'll be the auto algo follow market as well. That some would already be supporting your facility anyway, but there might be some additional capacity out there. And there'll be a lead and maybe an alternative lead, so still slightly manually following.
The leads tend to take about 40%. So we're talking about the 60% follow. And of that, how much goes into trackers versus other follow capacity. So we look at the trackers. The parallel here is in the equities market. And actually, if you look at the US equities market, the most mature equities market in the world, that's running at about 53% is in trackers. So that's probably an absolute upper limit. At Marsh, we're thinking more like 30%. And 30% actually probably would be our upper limit. And actually, we're already there in some lines. So if you look at something like marine, obviously we have our house facility, fast track, that's the priority. But then we have slipstream. So fast track does 10%, slipstream does 20%. We're at 30%. So that's probably about right.
More or less optimal.
Yeah.
Well, one of the things that we all love about trackers is this fantastic revolution that we've had in the last 20 years where, where the fund managers used to take 2% or 1.5% or whatever it was. And now they're right down to 0.1 by Vanguard. Who doesn't love that? It's wonderful because, the little bite being taken out of my returns every year is painful, particularly as it compounds over a long period. But how big could London be if it's £100 billion now? What could it be if it embraced this new form of trading?
Okay, so right now, the best estimates are that about 15% of commercial risk is actually insured or insurable. Okay, so there's an 85% protection gap, which means that we could be 7 times as big. I'll come back to explain some of how we could bridge that gap. Equally, if you look at projections for the next 10 years in terms of the overall size of the market, we think it's probably going to double, and that's conservative based on some of those projections. So the market in 10 years' time could be 14 times bigger. You close the protection gap, you've got the natural growth in the quantum of risk, because, by the way, what's happening in the world is only making it riskier. We could be 14 times as big. The total global market right now is about $1 trillion for commercial insurance. So we could be $14 trillion. That's the prize for all of us.
Are we effectively globalizing the London market? It's already global anyway, but if you fully digitize it, does it mean, yes, Santiago, Chile, you press a button and you get the London line?
Well, our job as global brokers is to match risk to the best solutions wherever they may be in the world. If those solutions are in London, fantastic. If they're not in London, by the way, then we have a problem. And that's why this cost differential of 10% is an existential threat, frankly, for London. But if we can get it right in London, every broker is working on some form of matching capability, which means that we can help risks find those best solutions. So say if they're in London, we can make that happen.
We talk about London. Obviously, you're a global broker. Some of the facilities that I've been reading about that Marsh are doing are non-London is also participating. Are there any other hubs or markets in the world? The one thing about London is it knows it's got this existential threat, and it is one of the places where everyone's present and is trying to do something. Is it happening in any other markets?
We have an incredible advantage in London in that we are all in one place. We are all collaborating. A lot of the stuff we're doing is as a marketplace, not just as
It's a great paradox. We're all here, but we're all competing and we're all collaborating and we all have the same existential threat.
Yeah, that's it. And that existential threat, that is making us change in a way that no other marketplace is changing.
It's the burning platform. We know we have to jump because otherwise we're going to be...
Yeah. And as I say, no other marketplace anywhere in the world is doing anything as interesting as is happening in London.
Is it mostly because they don't have the imperative?
Yeah, I mean, we certainly have an imperative in London. I think we also have a lot of talent in London. We have a lot of people that are looking to change the marketplace. There's certainly a cross-pollination of talent, by the way, between the brokers, between the insurers. So I think there's a commonality of purpose now, which just hasn't been the same before and certainly doesn't exist in other markets.
One of these old chestnuts I'd like to roast with you is that what's the role of the broker going to be like? And one of the things the broker's supposed to be good at is to know exactly what the underwriters are going to want so you can anticipate everything before you go in there, do your job properly. You know what they're going to be worried about. You know pretty much what they're going to charge as well. When you get to algorithmic underwriting, is it your job to sort of reverse engineer the algorithm? Or maybe you don't need to do that because if the quote comes back 3 milliseconds after you've sent the request for a quote, I suppose it doesn't really matter, does it?
The short-term answer to that is we're matching risks to best solutions. I don't really need to understand how that has been priced. I just want lots of offers from a vibrant competitive market. I'm going to match to the best one. I think longer term it becomes more interesting because actually, having worked with some of the most sophisticated risk managers in the world, they're not buying insurance, they're selling risk. So they are using analytics to get to a technical price, and then they're figuring out whether the market is above or below that price. And if, frankly, the market is too expensive, they will retain that risk, perhaps through their captive or just by taking bigger retentions. If the market is cheap, they will offload it. And that's probably what a broker should be doing longer term. We should probably understand the risk better than the marketplace, understand the technical price, and potentially warehouse it ourselves if the price is wrong in the marketplace, or offload it if it's not.
Yes, but obviously we know the financial world, the investment banking world, market makers and those proprietary trading desks, that does get us into a bit of trouble. Do you think we'll ever get over the ethics of that? Who am I working for? Am I working for myself? or am I working for the client?
It's a great question. My second startup was actually competing against the big banks who had the prop desk. And the offer was the purity of execution only. In fact, we called the company Execution.
Right.
And as you said, Vlocker basically put the prop trading desks out of business post-2008. But before that, they were making 20% of the profits of the big banks. So it does become quite compelling. But yes, there's clearly a tension there between are you looking after the client's best interests or your own balance sheets. But from a market-making perspective, to facilitate a trade whereby actually you're finding it tough to get away the last 20, 30%, you could keep that on your balance sheet for a while to facilitate the trade getting done, then maybe that's okay.
You can take your own view. Yes, that would be quite interesting. I suppose, yes, obviously you need all the different protections and the different barriers and walls, etc., between those different parts of the same business. I suppose it would have to be very clear who everyone's acting on behalf of.
Absolutely, yeah.
What about AI? Are you going to get AI to do all this for you? I mean, how much of the AI going to be sitting there with that broker with their screen and the AI saying, you know what, this looks just like that thing you did last week, and here's a better way of doing it. Or I've already analysed what you did last week, and actually now, with the benefit of hindsight, we could have done it better this way. What do you think? Is it going to be that kind of thing? Okay, not like the annoying paperclip you used to get on Word, but something like that, but something much more helpful who's not annoying, who's got really good ideas.
Every technology goes through this kind of adoption curve, and it goes from hype to kind of what they call the trough of disillusionment, and then there's enlightenment. And I do feel with AI, we're kind of in the trough of disillusionment.
Well,
right?
everyone gave it a go, yes.
And now it's like, well, it's just being used for personal productivity gains. I can summarize an email or get a Zoom chat turned into a transcript. That is not where we're going. We've barely scratched the surface in terms of the potential of AI. At Marsh, we've been working at it for 2 years now. It's a huge program of effort, a huge amount of investment. And what we're doing is going to be game changing. We're going to see AI taking on roles that you'd never think it could have taken on before. So yes, absolutely. In our future, we will be amassing the world's knowledge of risk management, everything we've ever learned, and combining that with everything that Marsh has ever learned and putting that at the fingertips of our brokers. We will be matching risks to the best solutions using algorithms. We will be using AI to place the business into the market and automating activities which, frankly, don't need a human to do. So there is so much potential across the entire value chain with AI.
So, as I say, the story of AI has been, let's get rid of the boring, repetitive tasks, let them do that, and I can get on with doing some important things, talking to the lead underwriter. At what point do you think the AI, the agentic AI, would be doing the talking to the lead underwriter itself, and that lead underwriter might also be another algorithm, which they might not need human intervention?
I think it's about, as I say, automating the more routine, lowest value add tasks. So if I'm able to click a button to find my follow lines through a series of digital connections to the marketplace, offers coming back, automated ranking of those offers, and effectively I can execute a trade through a single click, then that's going to happen.
Of course, there you can also prove, if the regulator came back to you and said, why are you doing it this way? You can evidence that this is the best possible way you could have placed that at the best possible terms for my client.
Yeah.
Because, of course, a human broker, you can't always explain why you did it. And said, well, I don't know, because I bumped into so-and-so on the way down Lime Street. And so he ended up writing a 10% line. But was that necessarily the right order to have done that placement in? I don't know, because if I'd gone to so-and-so, I might have got it cheaper.
Well, I tell you, in the equities world, they used to have bundled commissions for research and execution, and then they unbundled it, and the regulator says, you have to prove best execution. And that led to a complete transformation of the cost of trading and the use of algorithms. They call it VWAP algo trading, for volume weighted average pricing. And you'll click a button and it would just go off and do its thing over a period of time. But you could guarantee best execution.
Because you can evidence it as well. You can say, I did this because I did that because of that, and I did that because of this. And
absolutely.
And it'd be pretty hard to argue with it.
Yeah, and there's no reason why we can't do that on some of the follow offers.
In terms of productivity, I mean, does it sound like we're still going to find employment for all these brokers?
You know what? I know that brokers spend around 35% of their time on the follow market, chasing down follow lines. So if we were able to do this and make it a single click, then of course they could redeploy that time to more value-add activities. Some of those activities will be around negotiating better lead terms. Some will be around innovating new solutions to close that protection gap I talked about, that 85%, which is the opportunity for all of us. So actually we see it as doing more with less. And by the way, we've pretty much doubled the size of our business over the last 3 to 4 years. We haven't doubled the size of our headcount. We are doing more with less already.
AI is good at writing code, right? Why wouldn't it be? It's a perfect application of AI. We're always, particularly in London, always tearing our hair out. We've got this blueprint we've always got some kind of business process reform, which is usually very, very painful because it's sort of lowest common denominator stuff. Do you think AI could just do it for us? Because it's one thing that AI is really good at. Couldn't it re-platform the whole of the London market?
If I had my startup hat on again, I'd be pretty excited right now. I mean, actually, it's a great time to launch a startup because you can do, again, so much more with so much less. You don't need huge amounts of venture funding. I can use AI for design, for coding, for marketing, for sales, right? It can take on many of the roles which before you had to hire people for. So actually, a vibrant startup community tackling some of those problems on behalf of the marketplace is very important right now.
People always used to talk about future-proofing. Do you think that's ever really possible? It's something that a salesperson will say, well, you can buy this and it's a modular solution or something and it's future-proof because you could just take bits out and put the bit that's gone obsolete and put it back, put something else in. Is that ever really true, do you think?
I think the technology today is such that actually you can, as long as you follow some principles.
Because it has the ability to be plastic, sort of rewire itself like a brain.
You've just got to make sure that it's called microservices and it's connected via API. So everything you build, you have to be able to get data in and out and to be able to use APIs to trigger actions. If you can do that, then you can fit into a broader ecosystem where you can just plug into the data flows. And as long as that data is in a consistent structured format, which it will be through the standards, then you future-proofed it. The problem comes when you go back to the mainframe in the basement you talked about. That is completely isolated. The only way of getting stuff out was to take a video of the green screen. That's not future-proof.
Another one of my old chestnuts is if technology has got to this stage where everything's so fast and the structure creates itself in milliseconds, the billion-dollar line with 20 different carriers is whipped up at the touch of a button. Do you think people really need old-fashioned things like treaties anymore? Because wouldn't, therefore, everything be facultative? Because it is, because it's all just at the speed of light. You can get $10 billion limit, if you press the right button.
I think ultimately this is just about connecting risk to capital in the most efficient way. And by the way, digital and having data flowing enables that to happen in completely new ways we haven't thought about. I mean, if you think about the Big Bang in the 80s for the equities market, that led to the emergence of securitization. So you could have, let's say, a portfolio of mortgages becomes a tradable instrument or a tracker becomes an ETF. That would enable in the insurance market, for example, there might be a hurricane bearing down on Miami and I could probably trade in and out of a wind portfolio. If I'm overexposed and I want to hedge, I could probably buy some of that. So if you have capital that's prepared to go long and short, then you can create ways of trading it. So securitization, you get futures around that as soon as you've got securities. So I think what we'll see is rather than kind of a shift to facultative, I think we'll see the emergence of completely new ways of bringing capital to risk.
I suppose, yes, you look at the portfolio solution, it's like a fund. It's a portfolio of shares, an equity fund. So yeah, it sounds like we'll still need those slightly bigger instruments, the ones that are funds and then funds of funds, etc. So it sounds like if we abolish treaties in the insurance market, we'd probably end up having to reinvent them somewhere in the capital markets end of it.
Well, exactly. And of course, remember, in the equities market, the secondary market is orders of magnitude bigger than the primary market, the primary being the equities capital market where I'm doing an IPO or issuing equity. The secondary market is order of magnitude bigger. That could be the same in insurance. There's no reason why I shouldn't be able to trade insurance on a secondary basis.
Wow, so we're going to end up with insurance day traders. You log on at 9:30 in the morning and then 4:30 you've either made a profit or a loss, but you're completely net zero at that point.
Or even better, you've got an algorithm running and it does it for you.
Absolutely. We've had a really interesting decade of the insurtech. I think anyone listening to this would already now understood you've established yourself as an innovator and a tech promoter and implementer. What do you think the lessons of this insurtech decade have been? Because we've had a lot of investment gone into different things. A lot of things have been thrown up against the wall and some have stuck and some haven't.
Yeah, I love doing startups, but I do think that a vibrant startup community is incredibly important. A lot of the best innovations in the marketplace do come from startups. That may not always be obvious because they may be acquired or they may be copied, frankly, but we do need that community. Now, as I say, I think now is a fantastic time to do a startup because you can do more with less. You don't have to raise lots of funding. By the way, that funding's a bit harder to raise right now given the valuations, but you can do a lot more with a lot less. I guess a couple of lessons from my time in that world. I think the first thing is you do need to focus on the real problem. So I talked about how many startups have been focused on the problem of getting data out of emails and documents.
It's crazy. I mean, I could go to, any massive InsurTech conference you name, and I will meet people who say, what are you doing? Or what's your main thing? Is that, I just get all these documents and I ingest them properly and spray them into the insurance company system.
Yeah, exactly. So that is not the real problem. The real problem is why those documents there in the first place. So you'll be much better off, for example, like Archipelago, creating a platform that hooks into a client system and allows them to manage their data through a platform as opposed to a spreadsheet to completely get rid of the document, as opposed to fixing that not real problem further downstream. So that's the first thing. Make sure you focus on the real problem. I guess the second one is you don't really want to be trying to compete against the big guys. I would absolutely advocate for partnering with the big guys. By the way, the big guys, certainly Marsh, we are actively supporting startups, especially through the Lloyd's Lab. And we are looking to work with startups because we want to encourage that community. And of course, if you do work with the big guys, then ultimately one day, hey, they may just buy you.
And that could be a good exit.
Absolutely, yeah.
We've had a really far-ranging conversation. Is there anything that we've missed? Because it's quite an expansive conversation. Do you think there's something we should be talking about that we haven't spoken about yet?
I think people are at the heart of this. And there's two types of people. There's the people who are already in the industry, and there's the people that are about to join or maybe should join or would want to join. And we need new talent coming through. I think for the people in the industry now, I can't stress enough how exciting a time it is to be in the London market. We're doing things which are unique here from anywhere else in the world. It is a fantastic time. And so if you are in the market, I would just encourage you to embrace change, be curious. If you're not in the market, again, what a fantastic time to come in. And by the way, if you do, you will love it.
I've really loved it. It's been really great talking to you again. I remember that brief time we worked together and I got some of that vibe of having you in the office. It was good fun. I really appreciate the time you've given, and I think we'll have to book in a time at some point in the future because things seem to be going at sort of warp speed here.
And accelerating.
Thanks so much.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.